It's October 2008. The air is thick with panic on Wall Street. Lehman Brothers just collapsed, shaking the very foundations of global finance. Banks aren't lending, assets are tanking, and people can't get their hands on cash. What went so horribly wrong in the world of money, banking, and financial markets to bring us here? Let's unpick this knot, starting from the heartbeat of money itself. Money might seem like just paper and numbers, but its role runs deep, pulling levers that move entire economies. Here's how it became the lifeblood of trade and trust. Back in early 18th century France, John Law convinced the king to let him run a massive financial scheme, the Mississippi Company. Investors flocked in, but it was all a house of cards. When the bubble burst, fortunes vanished overnight, proving money isn't just notes, it's confidence that can evaporate in a flash. Think of money like the ultimate handshake in a bustling marketplace. It's not the paper or coins themselves that hold value, but the shared belief that those pieces of paper can be exchanged for goods tomorrow. Without trust, money's just fancy paper. With it, economies hum. To prevent disasters like Law's bubble, countries created central banks, powerful institutions that act like referees. They control money supply and interest rates to keep things stable. This isn't some distant bureaucracy, it's the economic thermostat that keeps your paycheck meaningful. Banks aren't just where your money hides, they're where it multiplies and moves, shaping economic destiny. Let's dive into how they work behind the scenes. Imagine Sarah deposits $1,000 in her local bank. That bank doesn't stash it all away, it loans $900 to Mike for his new business. Mike then spends that money, which ends up back in the banking system, creating a ripple called fractional reserve banking. Suddenly, Sarah's deposit has magically multiplied into thousands circulating in the economy. In 2008, banks bet big on risky home loans bundled into securities. When those subprime mortgages started failing, trust evaporated. Banks stopped lending to one another. It was like a line of dominoes. One fall triggered a catastrophic freeze that rocked the entire global economy. Regulators stepped in hard afterward, tightening rules to prevent a repeat disaster. This helped prevent reckless behavior, but also sometimes stifled innovation. Think of regulations like tight leashes, necessary but tricky to balance because too loose means chaos, too tight means stranglehold. Financial meltdowns aren't random, they follow patterns. Understanding those patterns helps predict and maybe even prevent the next disaster. Mishkin's detailed timeline breaks down the 2007-2009 crisis into digestible chapters, from risky lending practices to asset bubbles bursting to the collapse of big players like Lehman Brothers. It's a fast-motion replay showing how greed, complexity, and weak oversight combined into a perfect storm. We often think only banks pose risks, but insurance companies, hedge funds, and pension funds hold massive portfolios too. Mishkin reveals how these non-bank financial institutions were pulled under by the subprime mess, exposing cracks in what seemed like a sturdy system. After the crisis, central banks used aggressive monetary tools, slashing interest rates, quantitative easing to reboot economies. It's a delicate balancing act, stimulate growth without igniting new bubbles. Mishkin shows why central bankers need a master's touch to keep the line between recovery and runaway inflation. Remember that October day when the financial world seemed to crumble? Now you see the story beneath, how fragile trust, the magic of banking, and the rhythms of regulation all played out. Next time you hear about money woes, think of John Law's bubble or Sarah's deposit spinning greater economic tides. Try this next week. Watch how your local bank handles your deposit. You're not just storing cash, you're fueling an entire system. Subscribe for more book summaries like this one.